Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Amprius Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we unpack the intense battleground surrounding today's stock, I want to quickly mention a useful tool for investors and traders.
Yeah, chart reading can be tough.
Right, it really can. So if you want help reading trading charts more clearly, you can check out VIP Algos. The link is below in the description.
Awesome.
Yeah, it's basically a TradingView indicator suite. It shows these visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even take profit and stop loss planning areas.
Oh, that's handy. What markets does it cover?
Pretty much everything: stocks, forex, crypto, gold, indices, futures, you name it. But just remember, VIP Algos is an educational chart analysis tool only. It is not financial advice. It does not place trades for you, and does not guarantee profit.
Right, trading involves risk.
Exactly. Always manage your risk and do your own research. And just a heads up, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Perfect. So, let's step back and look at the wealth building context here.
Yeah, let's do it.
Because when you're evaluating how a company like Amprius fits into a broader portfolio strategy, you have to be, brutally honest about what it is. And maybe more importantly, what it absolutely isn't.
For sure.
Like if you're looking at your portfolio right now and thinking you want a safe dividend-paying harbor or a steady defensive value play, this stock is going to give you serious heartburn.
Oh, yeah, that is putting it mildly. I mean, this is a high-growth, pure-play defense, unmanned aerial systems, or UAS battery manufacturer.
Right. It's a hyper-growth story.
Exactly. It's totally capital light. And the entire thesis here is anchored to this massive structural shift in domestic defense supply chains. We're talking about the U.S. government instituting a total ban on Chinese-manufactured batteries in defense systems.
And that ban takes full effect in 2028, right?
Yes, 2028.
Which, sounds like it's a few years out. But in the world of defense procurement, 2028 is practically tomorrow morning.
Seriously.
Yeah.
The military cannot wait until 2027 to start testing new batteries.
Right. The scramble to secure domestic, fully compliant energy storage is happening right now.
Yeah.
Which is exactly why the stock has surged over 160% year to date.
It's wild.
Yeah, it's trading around that $18.67 mark, and it's sitting right at this volatile intersection of defense tech momentum and intense short seller scrutiny.
Right. It is definitely not a quiet under-the-radar play. It's a highly volatile battleground. So, this is an opportunity strictly for growth-oriented investors.
Yeah, you have to be genuinely comfortable with massive price swings.
Exactly. Speculative momentum, catalysts driving the story. I mean, if you were an investor seeking current free cash flow to protect your downside, this ride will be incredibly uncomfortable.
Definitely. But surviving until that 2028 ban actually takes capital. And when you peek under the hood of their recent quarter, you see a company fighting really hard to scale up.
Yeah, the fundamentals are fascinating right now.
Let's dig into those mechanics. The current story is really defined by a pronounced hyper-growth phase. Like looking at the first quarter of 2026, they posted record revenue of $28.5 million, which is huge. Yeah, that's a 153% increase year over year, and like a solid 13% jump just sequentially from the previous quarter.
And I think the most vital piece of that revenue number isn't just the sheer size, it's the source.
Right, where it's coming from.
Yeah. 97% of their product revenue is now being generated by their new Secure silicon anode platform.
Wow, 97%.
Right. For an investor, that is a massive sigh of relief. It proves they've successfully transitioned away from their older legacy platforms. The market is actually adopting the new technology.
That's a huge de-risking event.
It is. Plus, they aren't totally reliant on one single region. Their revenue is pretty globally diversified. It's 58% in Europe, the Middle East and Africa, 21% in North America, and 21% in the Asia-Pacific region.
Which definitely insulates them a bit from localized economic slowdowns. And, as revenue scales, we are actually seeing the margins start to inflect.
Oh, absolutely.
Like in Q1, their gross margin hit 20%. And if you back out about $500,000 in non-recurring expenses from winding down some operations in Colorado, that gross margin was actually 22%.
And management is aggressively targeting 25% gross margins by the end of the year.
Right. As they get logistics smoothed out and push higher margin defense volumes, we're also seeing the net loss shrink by 46% down to $5.0 million.
Yeah. And management was confident enough to raise their full year 2026 revenue guidance to at least $130 million. They're projecting positive adjusted EBITDA of $4.0 million.
Okay, but hold on. I have to throw a flag on the play here.
Uh-oh, what is it?
Well, you mentioned the net loss shrinking, but if you look at the actual operating cash flow, it is deeply, painfully negative. I mean, we are talking about negative $54.3 million on a trailing 12-month basis. That is a massive cash burn rate for a company of this size.
It is, but
Yes, they have $62.4 million in cash right now and zero debt. But burning $54 million in a single year, that is a giant flashing red flag in any fundamental analysis. They are bleeding cash.
okay, I hear you. It looks like a massive bleed on the surface, absolutely. But we have to look at the actual mechanics of that negative cash flow.
Okay, enlighten me.
This wasn't just operational inefficiency, right? Like,
Yeah.
they weren't just leaving the lights on and paying too much for raw materials. It was a strategic liability clearing event.
What do you mean?
They paid a $20 million lease settlement to aggressively exit a facility in Colorado.
Wait, so they paid $20 million just to not use a building?
Yes, because look, by paying that $20 million up front, they legally eliminated over $110 million in future lease obligations.
Oh, wow.
Right, they just ripped the Band-Aid off. They cleared a massive structural overhang from their balance sheet to fully pivot to a capital-light model.
Okay, that changes the context a bit.
Yeah, going forward, because of that move, their capital expenditures are guided to stay under $10 million for the year. So that massive cash burn was essentially, a one-time pain to secure a long-term structural gain.
Fair enough. I mean, clearing a $110 million liability for roughly 20 cents on the dollar makes strategic sense. But a capital-light model only works if you have an incredibly heavy economic moat to protect those future revenues.
Oh, they do.
Because what is stopping a massive legacy battery manufacturer from just copying them?
So they have two massive pillars here. First is pure technological supremacy. They use silicon nanowire batteries. And to understand why this matters, you kind of have to look at the physics.
Right.
Conventional batteries use graphite to store energy, but graphite maxes out on how much lithium it can hold. Silicon can theoretically hold 10 times the energy.
Right, but doesn't silicon swell up and just, break?
Exactly. When you pump lithium into regular silicon, it swells up to 300% and physically shatters. It destroys itself from the inside out.
So how did they fix that?
Amprius solved this by using these nanowires. Think of them like incredibly microscopic, flexible tree roots.
Oh, interesting.
Yeah, because they are structured like a forest of tiny flexible wires rather than a solid block. They can absorb that massive swelling without snapping.
That makes sense.
Right. And that structural breakthrough is how they deliver an energy density of 450 to 500 watt-hours per kilogram.
Wow.
That is nearly double the energy density of conventional graphite cells.
Wow.
And in aerospace and defense, weight is absolutely everything. Doubling the density means a military drone can fly twice as long or carry twice the payload.
Which is incredible tech. But the second pillar is arguably even more protective, and that's the regulatory moat.
Oh, the NDAA compliance.
Yes. They are fully compliant with the National Defense Authorization Act. They source all 11 of their internal battery components from fully compliant allied countries. Nothing comes from a restricted supply chain.
And that is huge, because once a highly advanced NDAA-compliant battery gets qualified and, baked into the design of a specific defense platform.
Like a multi-million-dollar military drone.
Exactly. Once it's in, the switching costs become astronomically high. It takes competitors 2 to 3 years just to go through the intense military requalification process.
Right. Defense contractors aren't going to halt production for 3 years just to save a few pennies on a competitor's battery.
Yeah.
Once Amprius is in, they are locked in.
Completely locked in.
Okay, so they have the tech, the cash runway, and the regulatory moat. But what actually moves the needle tomorrow? What are the near-term catalysts that could dramatically shift the price?
So first up on the immediate timeline will be the Q2 2026 earnings, which are expected in August.
Okay.
The entire market is going to be hyper-focused on one specific number, $32 million. They need to clear $32 million in quarterly revenue to validate that $130 million annual run rate they promised.
And if they miss that, the growth narrative takes a severe hit.
Exactly. And beyond the raw earnings, there are specific contract executions we really need to monitor. There's a $21.0 million purchase order they secured from a major Chinese mobility customer.
We need to see continued flawless deliveries there.
Right. And even more importantly, we need to see actual revenue flowing from their expanded $18.1 million contract with the Defense Innovation Unit, or the DIU. That's as they scale up their pilot manufacturing line in Fremont.
But, pulling back from the micro level, the U.S. defense budget cycle itself is kind of the elephant in the room here.
Oh, absolutely.
There is a proposed $58 billion budget for the Defense Autonomous Working Group. That's alongside the broader initiative known as Replicator.
Right. And these aren't just vague government ideas.
No. These programs essentially create a massive guaranteed vacuum of demand specifically for NDAA-compliant drone batteries.
But here is where my skepticism kicks in regarding those macro tailwinds.
Oh, how so?
The stock is already up 162% this year. The massive institutions buying this stock, they already know about the Replicator initiative. They already know about the proposed defense budgets.
That's true.
Isn't there a very real argument that all of this guaranteed demand is already perfectly priced into that $18.67 share price? I mean, if everyone knows the good news is coming and it's baked into the current valuation, even a slight delay in Washington could cause a violent correction.
That's actually the perfect pivot to the technicals.
Yeah.
Because catalysts tell us the what and the why, but the chart tells us exactly how the market is digesting that information in real time.
Right, the actual price action.
Exactly. And looking at the price structure, Amprius has completely transitioned. It is no longer this speculative post-merger story stock hoping for a break. It has been re-rated by the market into a genuine momentum leader.
Yeah, the trend is undeniably strong. At $18.67, it is trading firmly above all its key moving averages.
Right.
The 20 days at $18.01, the 50 days at $18.28, and the 200 days way down at $12.88.
Wow.
Yeah, that gap between the current price and the 200-day moving average is the visual definition of a structural bullish uptrend.
But the volatility within that uptrend is intense. We recently saw a 5.33% single-day surge.
Yeah, which points to a lot of emotional, aggressive buying from retail and momentum algorithms.
Right. Yet at the same time, if you look at the MACD, the moving average convergence divergence indicator, it is sitting slightly negative at negative 0.05.
Which is interesting for those trying to visualize that. Think of the MACD like the RPMs on your car's engine.
Okay.
The stock price might still be moving forward up a steep hill, but a negative SCD means the engine is starting to lose that aggressive acceleration. It's indicating a slight loss of near-term momentum. The stock is essentially taking a necessary breath after a completely vertical run. It is fighting serious friction at these higher levels.
Well, some of that friction was actually structural overhead supply, which management just brilliantly cleared out.
Oh, you mean the warrants?
Yes. They recently had over 7 million public warrants exchanged for common stock at $11.50.
Right, and to translate that, warrants are basically IOUs that let investors buy stock at a fixed price later on.
Exactly. And the problem with warrants is they constantly threaten to dilute the pool of existing shares.
Yeah, whenever the stock price gets high, the market fears those IOUs will be cashed in. It acts like an artificial ceiling on the stock price.
Right. So by converting them now, they ripped off another Band-Aid. Yes, it introduces new shares into the market today, but it fundamentally removes a massive long-term dilutive overhang.
Getting those warrants off the table really clears the path for much cleaner upward price discovery. You don't have that constant threat of future dilution hanging over every rally.
Exactly. Which brings us to the market sentiment. Because while the chart shows friction, the broader market narrative is an absolute war zone.
Oh, it really is. It is a classic, violent clash between growth-focused investors looking at the future and valuation purists looking at the present.
Let's start with the bulls. Institutional confidence remains surprisingly high for a stock this volatile.
Yes, strategic investors like Airbus Ventures and AeroVironment are maintaining their stakes.
Which signals heavy industry validation.
Definitely. And the analysts are throwing gasoline on the fire. Clear Street initiated coverage with a buy rating and a massive $33 price target.
Wow.
Yeah. Cantor Fitzgerald and Craig Hallam both raised their targets into the 19 to 21 range. They're looking strictly at that NDAA defense mode and modeling massive upside.
But the bearish side is loud, organized, and they are pointing directly at how parabolic and disconnected this run has been.
Right.
Seeking Alpha actually downgraded the stock to a hold, citing extreme valuation concerns. And then there is the explosive short seller report from Manatee Research.
Oh, the Manatee report.
Yeah. They alleged exaggerated orders and most dangerously hollow manufacturing.
Let's zoom in on that phrase because it is designed to cause panic. Hollow manufacturing.
Right.
When a short seller claims a manufacturing company is hollow, they are heavily implying that the operational core is a mirage, that they don't actually have the capacity to build what they're selling.
So is there fire where there's smoke here?
Honestly, that specific allegation from the short sellers fundamentally misinterprets the company's entire intentional strategy.
Course.
Amprius operates on a decentralized, capital-light model. They aren't trying to build massive, multi-billion-dollar gigafactories from scratch themselves. Instead, they partner with established contract manufacturers like the Korea Battery Alliance and Nanotech Energy.
Oh, I see. It's essentially the fabless semiconductor model applied to batteries?
Precisely.
Yeah.
Look at how AMD designs incredible computer chips, but they don't build them. TSMC physically manufactures them in Taiwan.
Right.
Amprius is doing the exact same thing with advanced batteries. It's not hollow. It's a deliberate modern strategy to preserve their cash runway while scaling production rapidly without taking on billions in debt.
That makes a lot of sense. There is also a massive amount of speculation floating around the market to fuel this sentiment war.
Rumors.
Yeah, rumors. Because Amprius holds dominant intellectual property in those silicon nanowires, and because they have that incredibly rare NDAA compliance, there are constant, unconfirmed rumors that they could be an acquisition target.
Like for aerospace giants like Boeing or Airbus.
Exactly. On top of that, there's speculative chatter in Washington about a massive, one big beautiful bill, a defense spending package that could unlock $500 billion.
Wow.
Yeah. If anything even close to that passes, it acts as a colossal, completely unpriced tailwind.
Well, rumors are exciting, but we really need to pivot and talk seriously about the risks in the bear case here.
Yes, we do.
Because ignoring the downside is exactly how you get burned in momentum stocks. And the biggest risk here ties directly back to that decentralized manufacturing model we just praised.
Right. Not owning the factory comes with a massive cost.
Yeah.
Execution risk.
Exactly. 97% of their product revenue relies entirely on that new Secor line. And that entire line depends completely on those contract manufacturing partners, Korea Battery Alliance and Nanotech Energy.
So if those partners experience yield failures, meaning the batteries coming off the line are defective, or if they hit supply chain bottlenecks or have any quality control issues, Amprius' entire revenue ramp stalls instantly.
Right. They do not control the factory floor. That means they do not have complete control over their own execution destiny. If a partner stumbles, Amprius takes the fall.
Then there is the undeniable reality of their current valuation. The stock trades at a steep 42 times trailing price to sales ratio.
Which is incredibly high.
But let's be very clear about what a 42x multiple means. It means you are paying $42 today for every single dollar of revenue the company generated over the past year.
Wow.
Yeah. One deep quantitative valuation model even suggests the stock is currently 17% overvalued against a fundamental fair value of $19.25.
And remember those 7 million new shares from the Warren Exchange.
Right, the ones that cleared the overhang?
Yes, it cleared an overhang, but it also expanded the total share count. So to outgrow that dilution and to justify a 42x sales multiple, the company must execute perfectly to reach positive free cash flow.
That's the key word, perfectly. At 42 times trailing sales, the stock is quite literally priced for perfection. There are no shock absorbers built into this price. Any hiccup in partner manufacturing, any bureaucratic delay in defense procurement, or any slight slowdown in their targeted $130 million revenue run rate breaks the thesis entirely. It is an incredibly tightrope they are walking.
It absolutely is. The upside is capturing a multi-year defense supercycle, but the downside is a severe and violent multiple compression if growth slows down by even a fraction of a percent.
So, weighing the revolutionary tech against the sky-high valuation, what is the final verdict?
Based on our analysis today and the catalysts, the final bullish score comes in at an 8 out of 10.
Okay, an 8 out of 10.
Yeah. The core stance here is that Amprius Technologies is arguably the premier domestic pure play on the upcoming defense UAS supercycle.
But it's a long-term play.
Definitely. The target horizon for this is a multi-year, I think 12 to 24 months minimal. That extended time frame is really necessary to capture the full margin inflection as they scale and to see the actual deployment of these major defense programs. The primary driver for upside is unequivocally that regulatory NDAA moat and the massive switching costs it creates for the military. But the main risks remain execution of the partner facilities and defending that premium valuation.
So it's for risk takers.
Yes. This is a story for investors who embrace volatility, not those seeking safety.
And a clear reminder that this analysis is not financial advice. Always weigh the massive upside against your own personal risk tolerance.
Exactly.
And if you want a cleaner way to read the volatility on those trading charts, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TP and SL planning areas.
It's super helpful.
It really is. It can help make complex charts easier to scan, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if today's analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.
As you close out today, think back to that image of a stock sitting at the volatile intersection of defense tech and short seller controversy. The question isn't whether the nanowire technology works, the physics prove that it does. The lingering question you have to ask yourself before touching a stock priced for perfection is this: can a capital-light company truly control its own destiny when it doesn't own the factory floor? Keep a very close eye on their execution.